the macroeconomic picture of India, which is looking very good thanks to the improvement as far as India's current account deficit is concerned. The numbers have been released, and for the last quarter of the financial year 2022-23, which is the January to March period of this calendar year, the current account deficit is down to just 0.2% of India's GDP. Now, bear in mind that contraction is from the previous quarter, where the current account deficit was 2% of India's GDP. Kartik, quite the shocking narrowing, and all this is being attributed to an improvement in exports, specifically computer services exports.
Absolutely, Krishna, and great news given the fact that this is Q4 that we're talking about, 0.2% of GDP in Q4 over a grown GDP from Q3 to Q4. So it's a higher GDP and a lower percentage of current account deficit, which comes, of course, as compared to both Q on Q, which is Q3 versus Q2, as well as year on year. So Q4 of FY22 versus Q4 of FY23 has also seen an immense narrowing of current account deficit. So what is CAD? I think let's break it down. Current account deficit is primarily the value of your exports versus the value of your imports. If you are an import-driven economy, which India is, you usually have a current account deficit, whereas if you are an export-driven economy, let's say like China, then you have a current account surplus. So India has actually in its earlier avatar, before the services sector sort of became as vibrant as it is right now, has seen the current account deficit as high as 4.4% of GDP. From there, in Q3 to a 2% in any case was narrowing, and now to 0.2% really goes on to show that, our exports have done well. And this, of course, is mostly IT exports, computer exports. And, of course, we've seen other highlights of green shoots in the economy when it comes to electronic exports, especially the mobile phone segment that has done well. And India's overall bid to attract investments in the country and those translating to manufacturing output is likely to only make things better. Now, this also comes on the back of some other green shoots in the economy, which is primarily that our forex reserves with the RBI are back to about $600 billion. Now, remember last year, to keep inflation rate cuts that happened due to inflation under check and not let the rupee get too devalued, RBI had actually taken this decision to sell a lot of the greenback that it kept in its house to keep the value of the rupee stable. Now, we have incidentally been able to buy back some US dollars as well, keeping the forex reserves also at a $600 billion range, which I think all of this augurs really well for the economy.
Well, absolutely. We're talking about, I want to also touch upon the fact that the trade deficit. The trade deficit is also down to just around $50 billion from $70 billion. So that's another thing that we can keep a track of. And also the private transfer receipts, Kartik, I want to put the focus on that. Private transfer receipts are remittances made by non-resident Indians or Indians employed abroad who were gone out and then send money back. That was up by nearly 21% to $28.5 billion. So that's also something that's a good number. And I also want to put the focus on FDI. Net FDI, Kartik, was at $6.4 billion, up from just $2 billion in the previous quarter of the previous financial year, which is Q3 FY23. So net FDI is up, private transfer receipts are up, and here you go, net FPI, which is foreign portfolio investments. So net FPI outflow, you're talking about investors pulling money out of Indian stock markets. That outflow is down to just $1.7 billion from over $15 billion in the Q4 of the previous financial year. So that also tells you another story.
Absolutely, more investments coming into India, lesser Indian money going outside of the country.
Yes.
So overall, I think the whole story is adding up really well. And of course, I mean, all of this comes on the back of India being able to to become an integral player for the world when it came to China Plus One. Up until now, the world's focus was squarely on China as the one and only exporter, and India was not really seen in the same light as China when it came to competence of export potential as well as investment potential from investors internationally to invest in a country outside of China. Now, all of that has also changed for the positive and for the betterment of India. So, overall, lesser Indian currency flowing out of the country, more investments from abroad coming into India, and the overall trade deficit also narrowing suggests that we are not as import dependent as we were, and our export potential has proportionately gone up as well.
The only thing I want to notice, figure out here is, Kartik, our services exports are our strong point, are our strong suit, and they continue to save us. It's really a question of how well non-services exports grow in India, isn't it? Because that's where the focus is on, make in India, made in India, manufacturing.
For China Plus One to work, manufacturing has to move to India. And we've already seen part of Apple manufacturing moving to India. The three big Apple manufacturers, contract manufacturers, are all in India, up until now producing only the casing and the screens and some of the other components that go into production of Apple devices. But now we've got iPhones also all set to get manufactured here in India. So overall, I think the focus of the world to look at India as a clear investment destination, as a clear alternative to China when it comes to manufacturing of goods, and of course we continuing to work harder on our IT and services prowess by and we've seen deals coming. Yesterday we saw Infosys bagging a European order for about $460 million or so. TCS last week had bagged a deal of about $1 billion from UK's pension service. So IT is continuing to grow, service exports are continuing to grow, and the China Plus One when it comes to manufacturing is also being seen a little more seriously. And of course, I mean, we had Prime Minister Modi in the US, and we have the likes of Micron or Applied Materials making very clear statements of intent, at least when it comes to making it clear that they want to look at India, look at investing in India that much more seriously. Of course, India still has inherent challenges when it comes to augmenting the manufacturing story. And that comes on account of land acquisition, labor reforms. So apart from, let's say, states like Gujarat, states like Tamil Nadu, states like Karnataka, a lot more has to be done to make this manufacturing process barrier-free, frictionless, and of course competitive.
Right. The only thing I wanted to ask is, these numbers, we're talking about quarterly numbers, which have given a great reprieve. But if you say, look at FDI for the financial year 2023, it's lower than it was in the financial year 2022. So in that sense, these numbers also have to be taken with a grain of salt. We're talking about the fourth quarter of the just concluded financial year, which concluded on March 31st, 2023. So in that Jan to March quarter, just to put things in perspective, all the numbers we're discussing, the narrowing of the current account deficit is coming from these numbers for the last quarter of the financial year. So, these numbers will have to stabilize, Kartik, over a period of time as far as to get a real picture of where exactly is India's current account deficit.
That's right. And with the GDP growing and expected to grow to what, 7.2% or something this year. So with overall the expectation on the GDP to grow, it has to come on the back of 2-3 key components. One, of course, is keeping the net export high, which is, of course, your trade deficit. Link it with investments, it's your current account deficit, but largely keeping your X minus I, the export minus import, as close to zero as possible or very little in the negative. Then, of course, investments both in the public investment space as well as private investment, and private investment both through domestic players as well as FDI coming into the country will have to be worked upon. And consumption, of course, being the real bedrock of development, go by any index, not just the formula of calculating GDP, consumption has to be given a fillip, which is also likely if, if we were to believe the minutes of the MPC just concluded earlier this month and released last week. if we were to believe that RBI would be able to hammer down inflation to about 4%, and there would be immense pressure on RBI to do that because we are in election year.
Absolutely.
So if inflation were to be under check, if not 4 but definitely a sub 5% range, then consumption should not have any bad news as well. But bear in mind, El Nino, delayed monsoon, flooding, all of these could play havoc when it
Fair
comes
enough.
to
Those
India's
concerns
growth story.
remain. Those concerns remain. Monsoon concerns remain as we speak
Act
about
of God.
as far as the macro picture of India is concerned. But you were talking about the current account deficit and how that needs to be taken a long-term view as far as the current account deficit is concerned. Boosting exports will be step number one. You're talking about the consumption story. I'm extremely glad that so much of money is getting remitted by Indians who are employed abroad. And for another great fillip for consumption, right now the talk is that rate cuts could come in the first quarter of the next calendar year, or the third quarter or the fourth quarter of this current financial year. So we'll wait for that as well. But
again,
on.
Look at it. What Shaktikanta Das had said, that our focus is on taming down inflation. And our focus on rate hikes or rate cuts need not specifically mirror the Fed's moves on rates. So I think we are fairly clear, fairly focused that inflation is the number one enemy we want to target, and whatever it takes. And rate cut is not going to help us tame inflation. So the El Nino impact, the effect of the monsoon, if at all it is not in sync with expectations, is going to start reflecting only in the October to December quarter, Q3 of this financial year. And if things look stable, perhaps a rate cut could be on the anvil. But I suspect we are looking at keeping rates unchanged for the next 6 months or so. And thereafter, depending on inflation numbers, I think RBI will have to take a call on either this hawkish pause that we are in. If inflation, owing to monsoon or other concerns, does not get hammered down, rate hikes can also not be ruled out. But rate hike, of course, is going to have a negative impact on the animal spirits of corporate India.
Absolutely.
To take loans, leverage themselves and contribute to growth.
Kartik, either way, the fact that the chances of them hiking rates at this stage remains low is already good news for corporate India, definitely. And then, of course, the sweetener is the possibility of a rate cut come January 2024, if I may. So, ladies and gentlemen, I'm going to put my money on a possible rate cut in the Jan to March quarter of 2024, but there is absolutely no guarantees. It's just my instincts telling me that, and that's hoping that inflation comes completely under control by December 2023. So that's where my instincts are premised upon. We have Rakesh Khar also joining us on this broadcast. Rakesh, good morning. Thank you so much for being with us. Great news as far as India's macroeconomic picture is concerned. Current account deficit down to just 0.2% in the last quarter of the previous financial year as compared to 2% in the previous quarter.
Absolutely. This is good news for the macro fundamentals, and I think they have a certain trajectory which is being, which has stayed the course.
Thanks.
Do remember that the annual, CAD for the last fiscal is more than what it was for the previous year. So in that sense, it is still, even with that level of 2% for the entire year, it is well within the range. What has contributed to the CAD, healthy trajectory are a couple of key factors. One is that, the oil prices, which is key component of our oil import, of our entire import bill, which leads to trade deficit, is by and large, in a certain range, which is favorable to India. And then foreign exchange, FDI inflows have also been, rather healthy, and there was a little weakening in between, and remittances are high. But I am of the view, this philosophy that certain set of economists follow is that a lower CAD and pushing for a lower CAD on the back of lower imports is not a great idea to my mind. If you really want to push the envelope, we'll have to not only push exports, we'll have to push imports at the same price, because you cannot take away the reality of imports being key component for India's economic growth story, especially in realms of manufacturing. So two things have to happen, and that is well within the articulated realm of the policy framework in this country. Corporate India has to buy in that completely, which has not yet happened. That, push for exports, both services and goods, there is a certain growth there, $750 or $760 billion for the last financial year, with a stated trajectory of $2 trillion by 2030. Noble intent, but needs a lot of hard work actually to match up with the target. and keeping hoping and praying that oil prices remain by and large within the range, and there's no further escalation on the Ukraine crisis. So that should help us keep CAD under check. And I agree with you. Going for the election year in January, possibly there would be a rate cut, which will further fuel the appetite of the corporate India to put in its best, which right now is slightly in the deficit.
Rakesh, just a quick input on what is your expectation when it comes to fuel prices. So we've seen OPEC Plus has cut production, and there have been talks of them cutting fuel production, oil production even more. So given that sort of environment on rate per barrel likely to go up and not remain where it is right now, do you think at some point the Russian oil that we are importing would also come under some sort of a pressure, even though Russia doesn't have other takers, for Russian oil to also become more expensive for India?
No, Russia has takers from China as well. In that sense, I think the stability, you're right, this apprehension is quite right, because when you cut down production, there's going to be a demand-supply gap. And but I've been reading reports, Kartik, from international economists who are saying that it might move up, but it will move up marginally, but and not at a level where it's going to be a grave concern for developing economies and developed economies as well.